The stock market is enjoying 3 years of excellent gains. 2025 has seen, especially the AI stocks, really go up. Now, at some point, they're going to stop going up and they may actually drop, especially if the story that, hey, we're going to keep spending money on AI begins to lose some of its energy. In that case, it'd be good to have some safety stocks, some stocks that are going to do well when everything else is terrible. And in this video, I want to look at consumer staples. These might be the most boring stocks on the stock market. They're not exciting, they're not growing, but these are household names. We know these names, they've been around for a long time. In several cases, they've been around more than 100 years. All of these businesses are mature, they pay dividends and are safe stocks. The other opportunity is that these stocks have somewhat been forgotten in a lot of ways. The headlines are really taken by the high growers, the exciting businesses, and these are somewhat left behind in some cases. In some cases, they're pretty expensive. What I want to do in this video is just go through the top safety stocks, consumer staple stocks, and rank them from which one is the best opportunity to invest in, which one is the worst, and arrive at, what would be potentially one or two stocks that I could add to my portfolio that are good consumer staple stocks. Let's get started. Walmart is one of the biggest companies traded on the exchange. They're $812 billion of market cap. This is a consumer staple stock, and it's rewarded investors over the last 5 years. It's gone up nicely, especially in 2024 and part of 2025, but it has plateaued. For the last 6 months, it hasn't really done much. The PE for Walmart is quite high, 38 for the current year, almost 37 for next year. And the company isn't growing very fast. It's a very big company, revenues of $693 billion. And they pay a small dividend, less than 1%. So far, I'm not liking what I'm seeing. I'm seeing an expensive stock that doesn't have a lot of excitement in it. Analysts do believe it's a strong buy with a discount of 8.5%. Walmart's not really growing all that fast. And I consider Walmart has two sides of competition. There's the legacy competition, which is Target, Costco, retail grocery chains like Kroger that are competing against Walmart. And Walmart does quite well in that particular segment because it has very good pricing. Now, tariffs are probably going to affect most of the companies I'm going to cover, but especially Walmart. They really do want to provide a very good value price to its customers. And either tariffs will force Walmart to raise their prices or force Walmart to maybe reduce their margins. And their margins are already quite low. So the growth isn't going to accelerate, I don't think. They continue to try to go online, but online is the other side of their competition, which is Amazon, as well as other e-tailers. But Amazon is growing at 13%, growing much faster. So Amazon's grabbing more of the market share, and in many cases at the expense of Walmart, as well as other retailers like Home Depot and others. When we look at margins for Walmart, they're not overly exciting. The margins are quite low, less than 25% gross margin, profit margin of 3%, free cash flow yield of 2%. These numbers are really, really small, but the company's so big that the scale is quite large. The free cash flow does look good, and I'll use that number to value the business. I'll value the business based on cash flow and discounted that cash flow to today's value, as well as the profits that I expect from the business. The balance sheet is good. Now, on Walmart, we have 31 analysts covering the stock, and on average, they think it's discounted by about 9%. This is strictly on earnings per share, and the growth is going to be single digit, 4 to 6% per year. And profits are going to expand better. So they're trying to get more profitability to the bottom line. And that should help. But it's still a very high PE. A company that's growing at single digit, low single digit, I just find it hard to believe the market would be paying 38 when it should be paying more like 18, maybe 24, since it's such a good name. So I think the stock high level seems a little expensive. Now let me get into my valuation and look at intrinsic value for Walmart. When I look at the value of Walmart based on the future free cash flows I expect from the business, and I also look at future profits, I get to a combined 51% premium that's being priced into the stock. I think each share is worth about $50 a share, but shares are being sold for 101. And this is an expensive stock. It's very well known. And I happen to have a theory that stocks that most people are very familiar with, they're comfortable buying the stock because they've been into a Walmart. They could see it, they could touch it, they can walk into a store and see that there's long lines at the checkout. Well, that's a simple way of looking at it. It's not that hard to find good businesses. It's really hard to find a great business at a great discount. And that's what I'm after. Walmart historically has been a great business, but it does not have a great price. It actually has a very high premium. It doesn't pay a high dividend. So collectively, Walmart's going to rank toward the bottom of the companies that I'm going to look at. Costco is a $403 billion market cap company with $275 billion of revenue. The business has rewarded investors over the last 5 years, going up 155%. Over the past year, they have not had a good year. They haven't kept up with the S&P. I think investors are at best just trading sideways. Year to date, the stock's actually losing a little bit of its price. When we look at the PE ratio, it's quite high. A 50 PE really should be attached to a good growing business that is just continuing to expand their profits in the future and their cash flows. So they'll grow into a higher earnings per share and lower their PE ratio. We'll see if that's the case for Costco or if indeed it's too expensive. The dividend is really low. Might be one of the lowest dividends we're going to see in this video. And the price targets based on analyst price estimates, they think this stock is discounted by 17%. So this company is growing a little better than Walmart. It's single digits. This is good growth. Costco has a membership program, and pretty much their membership program is all profit. It's not like they're having to put a lot of money into that particular membership other than just the expense of managing a long list of customers. So that's good that they have that. Their online business is growing, but it's not very significant. It's immaterial at this point. Their free cash flows are looking good, and they keep growing, which is good. Costco's, in my observation over the years, it's just never been a booming free cash flow company, but it does have a very good brand and a lot of confidence from investors that want to own Costco. Gross margins are even lower than Walmart, and their profit margins are really low. Free cash flow yield is also very low. So consumer staple stocks tend to have that characteristic, which is they don't make a lot of money because they're just reselling, items off their inventory. Now, analysts do like the stock. This has been a stock that some very famous investors have bought. There's a lot of goodwill with Costco and its investors. Revenues are going to continue to grow single digit, and earnings per share is going to expand nicely. But this PE continues to be high. I want to see a PE on a consumer staple stock. I want to see 18 to 25. The better company should have a 25. Maybe a company that's a little riskier is at 18. And for a PE to be at 44 for next year, that's just really high when the company's not growing that fast and the margins are really low. Costco is priced 31% too high. I believe each share is worth $636 per share, but shares are being sold for $916. And it's because their free cash flows really only measure up to a stock price of $675 per share. And even the earnings per share, when I use a rational 25, I get to $557 per share. So this stock here, I don't expect is going to appreciate very well into the future. Doesn't pay a very high dividend. Competition. I think Amazon is doing a terrific job of delivering value to its customer. And Costco is going to have that as a threat for really into the future. And I think it's going to continue to take away customers that really see the burden of having to go to Costco and shop there. Instead, you can just shop from your computer or your phone. That's really convenient. And you do get very good prices on Amazon. So I think that's going to be the main threat to Costco or keep them from growing into the future. Costco is not going to be ranked very high as a consumer staple that I would consider buying. I've never owned Costco for the reasons that I'm illustrating here, that I think it's a good business, but their growth isn't impressive and their stock is being priced way too high. Procter Gamble, they've got a variety of products like Tide, a lot of the products we use to take a shower, brush our teeth, clean our homes, just a lot of products that we consume on a daily basis. Very well known company, very well run. The stock hasn't done very well for the last 5 years. Your capital would just stood idle while the markets just flourished. The S&P's more than doubled in value in the last 5 years. So investors paid a big price to be investors in Procter & Gamble for the last 5 years. For last year, the stock has given up 9.43% of its price. And year to date, the stock is down 8.74. So it's not a pretty picture when it comes to the stock price. Looking at the market cap, this is a $352 billion market cap company, revenues of $84 billion. The PEs look rational, 23, 21, if they're growing a little bit. Dividend is pretty good, 2.8%. And analysts do see a nice discount in Procter & Gamble. We look at their growth, they have been growing single digit. And looking at their cash flow looks good. Cash flow has been really high and they sustained it at a high level too, which is good to see. Gross margins are much better than what we could see in Walmart and Costco. It's at 51. Profit margins are really good at 18%. That looks quite good. And then free cash flow of 16.6% yield. Looking at what analysts have to say about Procter & Gamble, they believe the stock is discounted by 16%. Looking at their forecast, they're going to grow single digit. They're going to grow their profitability. And their PE ratio looks pretty darn attractive. Compared to Walmart and Costco, this is looking much better as an investing idea. Procter & Gamble, the stock price is being priced at a fair value. Each share is worth $152 per share, and the stock is trading for $153. So it's right on the button. The cash flows come up with a stock price that's 12% below its current stock price. But the earnings per share show a nice 18% discount. I agree with what analysts are saying. They were at 17, I'm at 18. So Procter & Gamble is an idea. I think it pays a good dividend, just a little under 3. Very well valued and priced. It's a product, in their portfolio products are necessities. If we hit a bad market where you have a big sell-off in technology, communication services, the AI trade begins to really unravel, Procter & Gamble is going to do really well. So Procter & Gamble is going to be near the top of the list of investing ideas to buy into consumer staples as a safety stock. Coca Cola has been around for a long time and it's had a lot of famous investors. Of course, we know that Warren Buffett's one of its famous investors, but another that I'll point out is Ty Cobb. He was the great baseballer. Geez, he played like, I think 80 or 100 years ago. And it was shown that he knew some executives of Coca Cola. So he knew when to buy and sell Coca Cola stock. And Ty Cobb made a fortune investing in Coca Cola some 80 to 100 years ago. This stock, it pays a nice dividend of 3%. But over the last 5 years, it's only gone up 33.45%. And over the last year, it's gone down 6%. Year to date, it's doing okay, up 5.85. But I can't consider this a winning stock because the S&P went up 100%. $284 billion market cap with revenues at $47 billion. PE ratio at 23, forward P of 21. Analysts think there's a 16% discount available and that investors should buy Coca Cola. There's very little growth in their business. And they continue to try to grow where the market is moving towards energy drinks, bottled water are examples of where they're trying to move. I don't know that the actual soft drink sales are up. I know I personally don't drink soft drinks. I tend to just drink water. And I think a lot of consumers are feeling the same way. I think it's healthier and overall better for you. Free cash flow has really become a problem over at Coca-Cola. They were humming along, making or creating a lot of free cash year after year. And in 2024, that changed. And in the trailing 12 months, it's gone negative. Something's going on with Coca-Cola. where they're not producing free cash. I'm actually going to use an average to get their free cash flow into my free cash flow valuation schedule, because I can't use a negative number or I'd come out with a negative value. But there's something brewing here. There's a problem with Coca Cola, and I don't know that investors are concerned enough of the problems that are occurring. It's showing up in the cash flow. The gross margins look quite good, and profit margins look quite good, by the way. 25% net profit is very, very good. Analysts believe 16% discount. And looking at their revenue forecast, they're going to grow single digit. And their profits are going to expand faster than revenue. So that looks good, which should bring their PE ratio down. But in looking at that free cash flow trend, that's very concerning. I'm going to raise my discount level or discount rate, that I'm going to use on my valuation, because I'm seeing that this business is in trouble. Maybe it's a 1 or 2 year issue and they get back on track. Maybe it's not. And investors are taking a chance, an increased amount of risk. So we'll see how things play out. Coca Cola is being priced 25% too high. I think each share is worth $50 and it's being sold for $67. Principally, it's on the free cash flow valuation. I used a 3-year average, which is generous because their most current year is really, really low. And I discounted Coca Cola by 8.5, which is higher than any of the stocks that I've covered to this point. And that gives me a valuation that gives me a per share value based on free cash flows that I expect in the future of only $31, but the stock's way up there at 67. So it's a 53% premium that's being placed on the Coca Cola stock. Earnings per share will get us to a discount, but this discount's somewhat superficial. I think the business itself has some problems that it needs to address. We'll see if they're successful in addressing those problems that are causing negative free cash flow. Coca-Cola will be near the bottom of my ranks for a consumer staple stock that would be a good investing idea for me at this time. PepsiCo, best known for producing Pepsi, the drink, but they have an array of different beverages. They also have a snack business. The market cap for Pepsi is $191 billion with $91 billion of revenue. They pay a nice dividend of 4%. The P ratio is 25. Forward P is 16.87. And analysts think it's discounted. Over the last 5 years, it hasn't done all that great. Over the last 1 year, it's done terribly. And year to date, it's not doing well. The S&P is up 15%, and this stock's down almost 8%. So investors are falling behind if they're owning Pepsi. But it's not about where a stock's been. It's not looking at the rear view mirror. It's about looking through the windshield and seeing what's going to lay ahead. Let's take a look at more information from Pepsi. So the revenue hasn't been growing, and we'll see where their forecast lands, but they have a problem with growth in 2024 and 2025. The free cash flows have been doing very well. They grew them and have sustained a very good cash flow rate. They have good margins for a consumer staple company. They have good profit margin, not as good as Procter, but decent. And their free cash flow margin is decent, but not great. 7.7 is okay. Looking at their forecast, analysts believe that this stock is discounted by 12% together, but top analysts have it at 18. Their revenue is going to grow single digit, and their profits are going to expand nicely, bringing down their earnings per share. So Pepsi isn't a terrible idea based on high-level fundamentals. Let me do a full valuation now. Pepsi is being priced 10% too high. I think each share is worth $127, but the market's selling shares for $141. And it's principally because of cash flows. Cash flows are just not high enough to add up to the stock price where it's trading. The earnings per share look good. And if I am generous and give them a 25 PE, it actually gets me to a 37% discount. But overall, I trust free cash flows more than earnings per share. And Pepsi would not be a good idea. It's not a terrible idea. I think their dividend looks pretty good at 4%. But I'm not looking for a decent idea. I'm looking for a good idea. I'm looking for a stock that I could invest in. It could basically go up when all my technology and growth stocks go down. And I don't think Pepsi is going to get the job done. Philip Morris produces tobacco products, and the stock's been performing well for 5 years, up 104%. Over the 1 year, it's up 30%. Year to date, 28%. So the stock has been working and rewarding investors. The stock also pays a 3.5% dividend. So investors were seeing their capital go up in value, and they're receiving an income as well. That is great. Analysts think it's discounted by 27%. It's the big cap, $239 billion in market cap with revenues of $39 billion. The company is growing its revenues by 7%. They produce very good cash flows. Gross margins are 66%. That's the highest gross margin of the companies we've looked at in consumer staples to this point. Profit margin is good, and free cash flow yield is very good. So this business looks very good on paper. No surprise that the stock's really gone up in price over the last 5 years. When we look at the price targets, analysts believe it's still discounted by 27%. They believe the business is going to continue to grow. Those are good growth rates, and its profits are going to expand. So things look good for this company, and the numbers themselves look terrific. I completed my research and valuation on Philip Morris, and I believe the stock is being priced at a 4% discount. So I would probably just say it's fairly priced. $161 is what I believe each share is worth, but it's trading for $155. The free cash flows don't quite get up to the value of the stock or the price of the stock, but the earnings per share look terrific. I do agree with the analyst that earnings per share look good. Philip Morris is a decent idea as an investment that would do well during down markets. It'd probably rank toward the more positive side of my ranking toward the end of this video. British American Tobacco. The stock is up 41% over the last 5 years. Over the last 1 year, it's had a terrific rise of 45%. Year to date, up 41%. So this stock's really worked more recently. Analysts think there's still a 21% discount left, and they pay a very high dividend of almost 6%. $111 billion market cap with revenues of $35 billion. The revenues have been contracting, which is interesting to see the stock flourish. It's a British company, so they report semi-annually versus quarterly. And the revenues are contracting, which make me scratch my head. Why is the stock doing so well if revenues are contracting? When we look at free cash flows, they look good, but they are not expanding over time. The gross margins look terrific, 82%. This is the highest gross margin we've dealt with. And the profit margins are not as exciting, 11.9. It's a big drop off from 82 to 11.9. And the free cash flow yield is 34%, which is quite impressive. That is a very good free cash flow yield. Analyst. Only one analyst covers this stock, and he thinks it's discounted by 21%. More analysts weigh in on the forecast of revenues, and the business is supposed to grow single digit, and the profits are going to grow as well at a faster rate. And the PE ratio is supposed to drop, or the stock price will continue to rise. So the fundamentals, although a little mixed because the top line revenue isn't growing all that well, some other numbers are quite impressive, like the gross margin and the free cash flow yield is really good. I believe British American Tobacco is discounted by 27%. I think each share is worth $71 and shares are being sold for $52. That's a pretty good discount on a very stable business. They also pay a very high dividend. So this is going to rank toward the top of investing ideas in a consumer staple stock at this time. Altria Group, another tobacco-related company. Their stock is up 67% over 5 years. And if you consider they pay a very high dividend, over 5 years, you would have collected 30 to 35% additional value out of that dividend. You add that with your appreciation, you're at 100%. So very good stock to have owned for 5 years. The 1 year looks good, and year to date looks terrific. It's a $109 billion market cap company. P ratio is really low, 12.6, forward PE of 11.88. Analysts think it's a buy, but it's priced a little high. It has had a very good year to date. This business is also contracting, but not at a high rate. Very, very little revenue loss. They've had some positive and negative quarters over the last 4 quarters. Taking a look at the free cash flow, it looks good, nice and high. Gross margins of 71%, those look good. And profit margins look excellent, 43% profit margin, 43% free cash flow yield. Excellent. I think those are the best numbers we've seen so far out of these consumer staple stocks. There are 8 analysts that are covering Altria, and they think the stock is priced a little too high. The business isn't going to grow very much. Their profits are going to expand a bit. Their PE ratio is really low. So this does have a sense that it's priced well. It's done well, but not done just crazy well, which would feel like you're buying a very expensive stock. Now let's take a look at the valuation for Altria. Altria is discounted by 26%. Based on my research and calculations, the stock is really worth $89, but it's being priced at $66, offering a 26% discount. Both the free cash flows and earnings per share create a value that's above its current stock price. So Altria looks like a good investing idea that could continue to work and benefit investors. Unilever is a lot like Procter Gamble. They provide consumer products for personal care, caring for our homes, and so forth. The company stock hasn't been doing all that great for the last 5 years. Investors would have lost 7% of their capital price over the last 5 years. Over the last 1 year, they would have lost 6.9, and year to date, barely inked out an appreciation. This stock does pay a dividend of 3.36%. It's a $145 billion business with $70 billion of revenue. P ratio looks reasonable at 22 and 16 for the forward. Analysts think it's a hold. The revenues are not really growing. They're not contracting either. They're just holding their revenue line. Free cash flows look good and stable. And the gross margins are at 44, 45, which is decent for a consumer staple company of their type. Their profit margins are okay, and free cash flow yields are okay. Nothing overly exciting, but it's operating efficiently. No analysts are covering the stock, but we do have analysts that are weighing in on what they expect the business is going to do from a growth perspective. And they expect that the company is going to grow very little, single digit, and their profits are going to also expand. Unilever is discounted by 6%, offering a small discount. Each share is worth $62 and it's selling for $58. Its free cash flows are good and fall a little bit short of the stock price if I do an intrinsic value analysis on it. The profits of the company look good, and it actually produces a nice discount available on the stock. Now, this here is not really exciting, and it's going to be ranked in the middle of the stocks that I'm looking at for consumer staples. Mondelez is a food company producing foods and beverages available in grocery stores. Their stock hasn't been doing all that great over the last 5 years. It's only up 12% over the 1 year. It's down 11% year to date, only up 5%. It does pay a nice dividend of 3%. It's an $81 billion business with revenues of $37 billion. The business is growing, although not very quickly. It had good growth years in 23 and 22. Free cash flows have come down a little bit, but are quite stable. And their gross margins are okay, a little low, but okay. 19 analysts cover Mondelez, and they believe it's discounted by 13.6%. When we look at the forecast revenue, they're going to continue to grow nicely, which is good. And their profits are going to expand much faster than their revenue is going to grow, bringing down their PE ratio over time. I've completed my research and valuation on Mondelez, and I believe the stock is being priced 11% too high. Each share is worth $56, but it's being priced at $63. The free cash flow is just not high enough to value the company at its current stock price. The earnings per share look good, but I really depend on free cash flow valuations, which is the most trusted method of valuing a company. Mondelez is not overly exciting and will probably rank toward the bottom of my list of good investing ideas within consumer staples at this time. Kroger is a retailer of groceries. They run a variety of brands. Some of their biggest brands are Kroger, Ralph's, and others. The business is a $44 billion market cap business. Revenues are 3 times that amount. And their dividend is 2.1%. The stock over the last 5 years has done well, up 96%. Over the 1 year, it's done well. And year to date, it's done okay. When we look at their revenues, they are contracting a bit. Over the quarterly, it looks like they're flat. And this business is creating 23.9% margins, profit margins of 1.84%. This is the grocery business, very low margins, and free cash flow yield of 1.5. What they're trying to do is really be as efficient as possible. If you get a fresh produce item, you're not going to stock it for weeks. You're going to stock it for days and try to create the cash and profit from that produce, as an example. So they're really turning a lot of this product very, very quickly. Free cash flows are $2.2 billion. Forecast. We have 15 analysts covering this stock. They think it's 11% discounted. And they believe the company is going to continue to grow their business and expand their profits. The PE is nice and low. That looks really good. Kroger is discounted by 24%. And it's pretty much the same discount when I look at the cash flow and value the cash flow that I expect in the future, as well as the profits from earnings per share. And it pays a nice dividend. That's a nice discount from a very stable business. And buying groceries just isn't going to go out of style. People need to buy groceries. If we have a recession, a down economy, people will buy groceries more often and avoid eating in restaurants, which is more expensive. So Kroger is going to rank near the top. And Kroger is a stock that I own and have owned for several years and have done well with. So within consumer staple stocks, which are the best investing ideas for me, which are the worst? Let's go through from the best to the worst. Number 1, British American Tobacco. It's got terrific fundamentals. It's done well. It has a very good dividend. It's a good idea. If we have whatever economy going forward, consumers of their products will continue to consume their product. And the same goes with Altria. Very good fundamentals. And again, the consumption of that product is very, very stable. In third place is Kroger. It's a grocery business. Not quite as profitable as Altria and British American Tobacco, but so well operated. It's done really well over the last 5 years and continues to be priced at a point where it's going to continue to deliver good results. Now, moving down, what I would call is the quality ranks. Procter Gamble, not a bad idea, not a great idea. It's just a decent idea as an investment. Now moving down another rung where it would just kind of be stuck in the middle. And stuck in the middle is Philip Morris. I think that the best days for the stock price are behind them. And 2 of its competitors have much better valuations, much better fundamentals to offer investors. So I think Philip Morris may kind of be a bad investment. Unilever. Now, the demand for Unilever is going to be there, but the fundamentals don't look good. It actually is priced too high. And compared to Procter Gamble would be better, in my eyes, than Unilever. Now we're getting on to the bad part of the rankings, getting into the worst section. Walmart, not a good investment. It's done really well for 5 years. Impressive. But I think the stock price isn't going to do much going forward. And the same thing goes with Costco. The fundamentals for Costco and Walmart just don't look all that great. Pepsi, fundamentals do not support its current stock price. And I think this stock is going to be hit. It also sees new, fresh competition in the beverage category every single year. Mondelez, a food company. The fundamentals do not look good. It's just not a place I want to put capital into. And I think they're being priced too high. And the very worst stock that I could buy at this time is Coca Cola. The business has very negative cash that has to be explained. Its fundamentals, even when I take an average free cash flow, its fundamentals do not price out. This stock is too expensive. It's performed terribly for the last 5 years, and I think is going to be consistently a bad performer. And this would be absolutely the worst investment I could make within consumer staples. So my last comment on consumer staples. Consumer staples would be great for an investor that's older, somebody that's really trying to have a consistent, lower volatile portfolio, or looking to hedge. I'm sitting on a lot of gains right now. So an idea to hedge and say, hey, let me buy something that's safer is something that I am interested in if the situation is right. Consumer staple stocks, I would not think are good for young investors that are trying to grow their capital. If you're 20, 30 something and looking to invest for the next 20, 30 years before you want to begin to spend that capital, maybe fund your retirement or do something else with it. Consumer staples are not for the young investor, in my opinion. They're for the older investor or an investor maybe that is already very wealthy and just wants to sustain their wealth. So that's my video on consumer staples. It's a good idea to look into sectors when nobody or most investors are looking away. Investors are enamored with the AI trade, growth stocks that are really exciting. Well, they neglect this part of the business or this part of the market and could then create really good opportunities for the investor that's paying attention and could buy at a very good price and get a very good rate of return. So that's my video on consumer staples. Thank you so much for watching.